You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He's also an analyst at Bearing Asset Management. Welcome to the show, John.
Hey, Jim. Good to talk to you again.
Janet Yellen making her first pronouncement of the year. She said they'd be hiking interest rates in the U.S. No hint of it this time.
Yeah, she didn't say much of anything new, really. She basically just said, well, we're data dependent. If things keep going the way they think, or we think they will go, then we'll raise interest rates again later. But if not, not. And so the markets didn't really have much of a response to that. U.S. equities are up a little, but not a lot. And gold is up a tiny bit, but not a lot. And interest rates are down a little bit, but not a lot. So it was a real non-event compared to most Fed statements. Usually the Fed speaks, and the markets rocket upward. And the time before this, they went down pretty hard. So we usually see a pretty big reaction to the idea that there's adult supervision out there, that these guys who are smarter than anybody in the financial markets are going to take care of us. That's usually the reaction to Fed actions. And this time, not so much. So I think that means two things. One is that they didn't have all that much to say, and the other is that we're starting to lose faith in central banks. They try things, and things they try don't work, and people are starting to get that pattern. So if the markets do completely lose faith in central banks, then everything changes. We're not quite at that point yet, but we're heading in that direction. So the next few Fed meetings and ECB meetings and Bank of Japan meetings, these things matter because we're very possibly at an inflection point in market sentiment, in which previously we used to believe the central banks, take what they said at face value, and act accordingly. Now we're starting to question what we hear from them. And so markets are getting very choppy and harder to predict now. And so that could be the early stages of the next financial crisis. We'll have to see, but I think there's at least a decent chance that we're heading back into a 2008, 2009 kind of, everything blowing up at once kind of market scare. So we'll see.
Have central banks really become irrelevant considering the condition of the markets right now?
No, not irrelevant, but they're becoming a lot less important because the stuff they've done is now perceived not to have worked very well. In other words, we've spent the last 7 years with federal governments borrowing huge amounts of money, and central banks creating huge, a tidal wave of new currency, dumping it into the banking system, and pushing interest rates down to zero, and in many cases less than zero. And we're not in a rip-roaring boom like we should be with money creation at that level. We're actually tipping back into a deflationary bust. And so people are looking at this and concluding that central banks maybe are not all-powerful after all. And the central banks are going to respond to this in one of two ways. Either they're going to just stand pat and just let whatever happens happen, in which case we'll probably get a continuation of this descent into a deflationary vortex. It'll be very messy. Or they'll come back with something even bigger. They'll say, well, okay, that stuff didn't work. QE on the scale that we tried it in 2011 didn't work, so we're going to double it, or we're going to try something with a new name like debt jubilee or NERP for massively negative interest rates, and we'll see how that works. And it's hard to know what the markets will do about that, whether they'll respond to it because it's new in a positive way, or they'll respond to it in a negative way because it's really just an extension of the old stuff that didn't work. Someday, the negative reaction is out there waiting to happen. We don't know if it'll happen this time around, but there's a chance that it will.
I asked my correspondent in Japan, James Corbett, what the reaction was to Japan bringing in negative interest rates. He said the market went up for one day, and then it was right back to where it is, where it has been for the last 2 years, which is going down.
Yeah.
So,
Yeah.
It didn't have the big boost they thought it might have. And I still don't understand the theory behind negative interest rates. Why should I put any money in a bank if I have to pay them to hold it?
Well, no, that's what the government wants you to conclude. They want you to take your money out of the bank and spend it, because there's no point in saving if you get a negative return on your savings, right? You might as well go buy that new car, because the new car is going to depreciate, but so is your bank account. That's what they hope will happen. And meanwhile, if you borrow money, you might not have to pay anything for it. So borrow a ton of money too. They basically want to rev up the borrowing and consuming engine again. And that's based on a profoundly flawed economic theory that says that whatever else we do doesn't matter as long as we're consuming at a steadily growing rate. Like if we're buying more stuff year after year, it doesn't matter how much we have to borrow in order to get that consumption growth. Basic Keynesian economics that doesn't look at the balance sheet of society, and that's where they go wrong. Eventually you build up so much debt that you can't keep consuming, you can't grow anymore. And I would argue that we're pretty much there now. We've borrowed so much money that continued growth is basically a physical impossibility. And until we wipe out this debt somehow, we will never have a society like the 1960s and 70s and 80s where we grew 3 or 4% a year consistently. And so then the question becomes, how do you wipe out the debt? And you can only do it in a couple of ways, neither of which are pleasant. So we're into that stage of the process now where we got to choose which kind of a horrible thing to go through in order to come out the other end in a sustainable way. And the governments are going to choose inflation. They're going to try to lower the value of the currency until the debt becomes manageable. And that's going to hurt an awful lot of people who don't deserve to be hurt, but that's the policies that the world's government have chosen. And so that's what we're going to go through in the next few years. If the governments end up having the power to impose their will on the markets, we will see.
Deutsche Bank, considered one of the biggest banks in the world and one of the most solid. How solid are their foundations right now?
Their foundations are crumbling right now. Deutsche Bank is actually a very big story because, this is the biggest bank in Germany, which is the most successful country in the world, arguably. Germany is just considered to be rock solid. And for their biggest bank to be getting into the kinds of trouble that Deutsche Bank is getting into is sending chills down the spine of the global financial system, because basically Deutsche Bank borrowed a lot of money with some kind of weird terms. It's kind of an exotic kind of bond that they used to borrow money just most recently that is convertible into their stock, but also allows them to call the bonds in and retire them or not at the bank's whim, and to pay interest on them or not, with no recourse from the bondholders. And so that's fine when the company that's doing the borrowing is rock solid, but as soon as you start worrying about the company's welfare, you don't want to own a bond that the company can pay on or not pay on, right? So the price of those bonds are plunging, and that's one of the things that's spooking everybody, because Deutsche Bank is just, the quintessential AAA credit in the minds of most market participants, and now their bonds are plunging. So what does that mean? And it means that they aren't nearly as rock solid as everybody thinks. And then people look at their derivatives book, which is basically a series of bets placed by and among the big banks with each other and with hedge funds that are just insanely large now. Deutsche Bank's derivatives book dwarfs the entire European economy. So let some of those bets go bad, and it would only take 3 or 4% of those bets to go bad to completely wipe out Deutsche Bank and a big chunk of the rest of the European banking system. So suddenly there are lots of risks associated with this formerly rock-solid AAA untouchable bulletproof credit. And people are starting to think, well, if Deutsche Bank isn't rock solid. Is anything rock solid? You know, is there such a thing as risk-free credit out there now? And the answer is probably no. And people are starting to figure that out, and that's spooking them. So you're seeing money pour out of a lot of formerly safe entities like Italy and Spain, you know, which had low borrowing costs and decent credit ratings. Well, there's a lot of capital flight now out of those countries and into other places. So some of that is helping Germany, but now Germany, of course, has Deutsche Bank's problem, so they're not bulletproof anymore. And a lot of that money is also flowing into precious metals because that's really the last refuge of terrified capital. You know, if your financial assets aren't working anymore, you know, your stocks are going down, your bonds are suddenly risky, the cash that you had in the bank is yielding negative 2%, what do? You move into something that governments can't screw around with, like gold and silver. And you just wait. You know, you put your money in something that has been valuable for 3,000 years and therefore should continue to be valuable going forward. And that becomes the place where you hide out. So we're seeing that. Gold and silver are up lately, though nowhere near their previous highs. And money continues to flow into them. They're even up today on a day when the Fed has spoken, which is highly unusual. You know, usually the Fed sends money out of risk-off assets like gold and silver and into risk-on assets like equities. And today that didn't really work. Money kept flowing into gold and silver. So we're seeing a lot of old relationships break down, and they're breaking down to the advantage of gold bugs and to the disadvantage of traditional traders and investors.
Well, people who've always been high on gold and silver say good times are ahead, and perhaps the best places to put your money right now are the gold and silver miners. Gold miners more than silver.
Well, yeah, the mining stocks are basically options on the price of the underlying metal. In other words, they're highly leveraged to the price of the metal. And so if gold and silver go up, the miners go up by some multiple of what gold and silver did. So let's say gold and silver go up by 50% in the next 3 years. You'd see a lot of miners quintuple or more. And so that's the attraction of the mining stocks right now, is that if you like gold and silver, then you should love the miners. And a lot of people are concluding that with gold and silver going up, the miners are suddenly a place to be. You know, and it helps that they're so beaten down. They're really, prior to the plunge in oil prices, the miners were the cheapest sector out there. In other words, the most beaten down, most attractive from a value standpoint sector that you could find. And so you get a kind of a double pop with miners when gold starts going up because they become growth stocks immediately. But they're also very cheap on a valuation basis. So they become attractive and they show up on a lot of different people's screens. And so generally when you're in the mid to late stages of a run in gold, you see the miners just take off. You know, they become like .coms for a while. So I'm not saying that's happening right now, but I'm saying that is the dynamic. And when gold and silver are in an established uptrend, the miners will be probably the best performing sector in the whole economy. And whether that's 2016 or 2019, we can't say with any kind of certainty, but I think it's highly likely that it happens sometime in the next few years.
It's going to take a while for this to build up?
There's no real way to know what happens in the short run. Usually, bull markets start kind of slowly because most people are still very cognizant of what happened in the previous bear market. But then as people forget the carnage of 3 years ago and start looking at the nice profits that they made in the last year, they get cocky. And that's when you see, especially the junior miners, you know, you see money flowing into the precious metals complex overall, and you see the skew start moving towards riskier and riskier parts of the complex. So first the big solid miners move, and then the mid-tiers pick up, and then the little guys just rocket, you know, and that's the end of the process. When you see small miners quintupling in a year, that's your signal to start handing those miners off to somebody else, raising cash. But we're a long way from that now, and again, I don't know when it'll happen, but it's the dynamic that normally happens, and with the numbers being bigger than they've ever been, we should expect to see this dynamic next time it happens, next time it plays out, to play out on a larger scale than previous cycles.
Most oil storage facilities right now are near or at capacity. What's that going to do to the price of crude?
Yeah, that's one of the really scary things about the oil market right now, is that the price has plunged, and yet we're still overproducing. And the reason for that is a lot of wells were in the process of being brought online when oil started to fall. And so there's no real way to stop that process once it is going, because you've got all these sunk costs, and you might as well produce for whatever you can get for the oil in the open market, because it's still higher than your marginal cost of production. So you see a lot of new wells coming online right now to offset some of the ones that are being closed, and so we're still producing more than we're using, which means we're filling up our storage capacity. And the CEO of a big oil company just came out, I guess it was this morning, to say that that's his big worry, that the storage capacity is nearly full, and it's not clear what happens after that. Because normally, when you get close to that point, the price of oil plunges to take a lot of production offline right away and increase a lot of consumption. People will drive more if gas is, $1.50 a gallon or whatever versus $4 or $5 a gallon. So that would, in theory, bring things back into balance, but we haven't had that final crack in the price yet. So we might see oil go from, what did you say it was, $29 a barrel right now, down to 20. And that would be great for consumers and catastrophic for the junk bond market, where a lot of a debt was taken on to finance the last generation of oil wells, and for the marginal oil producers themselves, who might not be viable at $20 a barrel. And so we'll see a ton of bankruptcies. At today's prices, we will see a ton of bankruptcies and a lot of bond defaults, but at one-third less, a one-third lower price, we will see a tidal wave of bad things happening in the oil patch. And then the question becomes, will it infect the rest of the financial system? Is that the subprime mortgage market of this cycle? Something that blows up and looks like it might be well contained at first, but then just metastasizes and takes down big chunks of the rest of the financial system. And I think it's somewhere between possible and probable that it will this time around, because we've got so much else that can go wrong. If oil blows up and the junk bond market tanks, and then what does that do to, for instance, car loans or student loans or the housing market again? There are a lot of things that are very vulnerable out there, or emerging markets, or big banks, balance sheets. Lots of things could blow up in response to a crisis in the junk bond and energy markets. And so I think 2016 is going to be a year of sorting all this out and basically putting out one fire after another, and hoping that the fires don't start all at once, because if they do, that'll overwhelm the ability of the monetary authorities to keep a lid on it, and we might get an out-of-control crisis. 2008, 2009 was very close to a near-death experience for the global financial system. According to the big banks that were holding the government hostage in the U.S., we were a few days away from martial law. And the numbers are much, much worse now than they were then. So it's completely possible that we get something even worse than that next time around. And again, I'm not saying that's happening now, but when it does happen, this past January is what it will feel like. That's what the beginning of it will feel like, where just everything falls and nobody knows what to do about it, and the central banks seem paralyzed, and stuff like that. We'll see that, but on a bigger scale and on a much, much longer time frame. It'll be January writ large. So same kind of thing, but a year and a half instead of 1 month. And by the end of it, we'll feel like we're back in the Great Depression.
Well, I really don't feel like driving what we called a Bennett buggy, a horse pulling a car back in the 30s. But really, so gold and silver, good bets?
In that kind of an environment, yeah, because that's where terrified money goes. And to the extent that everybody's terrified, you're going to see basically everybody wanting to put 5 or 10% of their money in gold and silver. And right now, I think less than 1% of global capital is in precious metals. So you let that go to 5 or 10%, and, well, those markets wouldn't be able to handle it, first of all. There just literally isn't enough gold and silver at current prices to satisfy that kind of demand. So the prices would have to soar, and even then availability would be very limited. So it might be a question of the last people to that party being left out, just not being able to buy physical gold and silver really at any reasonable sounding price. You know, you might see it at $2,000 an ounce for gold one day, and $4,000 an ounce the next day if you can get it. You know, that kind of a panic short squeeze scenario. And so, you know, you shouldn't mortgage the house and bet everything on any one instrument or any one asset class. So don't go out and just put everything into precious metals. But do pay attention to the dynamic, which is very favorable for precious metals. You know, if you don't have any, buy a little. And then next month, buy a little more. You know, dollar cost average over a long period of time into something that you think will do well. And in the end, you'll do well. But never, ever place a gigantic bet on something that's this volatile all at once, because you really don't know what the world's governments and central banks are going to do in the near term to try to stop the carnage. And they could try capital controls, or they could try manipulating interest rates in ways that might turn out to be unfavorable for precious metals, or they might flat out ban the ownership of gold, which they did once already in the last century. So you can't know what the regulatory response is going to be to the market turmoil that's coming. And so nothing is risk-free, nothing is guaranteed. But I think a general shift from financial assets into real assets is probably the wise approach for this kind of an environment. You know, when things get really uncertain, you want to go towards things that are relatively certain. And farmland, for instance, is not going anywhere. Our government can't make any more of it, so it'll probably hold its value going forward. And we're always going to eat, you know. No matter what else we do or don't do, we're still going to put food on the table if we can. So farmland is good. You know, really well-chosen real estate in, say, you know, a rental house in a college town, something like that. That's probably okay, too. And precious metals are in that class. There's something that just can't be made more of out of thin air, and are also fairly liquid. You can transport them, you can turn them into cash whenever you want to, and therefore, they'll probably be in the class of assets that do well in an environment where governments see no option but to devalue their currencies.
John, thanks a lot for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.